It is my privilege now to welcome back our good friend Greg Weldon, CEO and President of Weldon Financial. Greg has decades of market research and trading experience, specializing in the metals and commodity markets, and has even authored a book back in 2006 titled Gold Trading Boot Camp, where he accurately predicted the implosion of the U.S. credit market and urged people to buy gold when it was only $550 an ounce. He's been making some other excellent calls in the metals here recently, and it's great to have him back with us. Greg, thanks again for coming on, and welcome. How are you?
I'm great. Thank you, Mike. My pleasure. I'm just very grateful that this storm spared us the carnage that it inflicted on the Bahamas. I'm here in Jupiter, Florida, and was supposed to be a direct hit here, so it was a pretty stressful holiday weekend down here.
Yeah, lots of different models. We're kind of all over the place with that, but yeah, good thing for your part of the world there. I'm glad to hear that. Well, for starters here, Greg, you nailed it yet again. We spoke back at the end of June the last time, and you were on the verge of making a major move into silver, and you were saying that if we could just take out $16.20, it would run pretty quickly from there, which it finally has. So give us a sense of what you've been seeing here recently in silver and what finally got the white metal moving, which got well over $19 earlier in the week. Now it is suffering a pretty big pullback here today as we're talking late morning on Thursday. So let's start with silver, Greg. What did you see that led you to believe that we were finally going to break to the upside from that years-long trading range, and then also talk about this pullback here today?
Well, I think it's kind of actually a common thread to both parts of the answer to your two-part question. And the first part is, what we saw was a dissociation in gold and silver, much more so gold, clearly, from the dollar. And the spread of gold rallying and then making new highs in such a widening basket of currencies, a lengthening list of global currencies. And it wasn't just some of the emerging market currencies where you can no longer accept the local currency. In a place like Angola, a big OPEC producer, is actually not as emerging an emerging country as you might think. On the other hand, given the currency dynamic there, it's very much an emerging country. So, you have places like Pakistan, Argentina, of course, the currency's blown up since, even more. But then you had places like Australia and Sweden, and it fed through to the whole thing in Europe where, you had the Swedish Central Bank and the Swiss National Bank with interest rates that were beyond minus 1% at the official rate. And the bottom line for me, Mike, the whole time was, the dollar's going to have to be the relief out because you have intense disinflation, deflation building just from the pure fact that you have so much sovereign debt in a negative interest rate. And I think that this was a big misstep by the central banks globally, particularly in Europe, because the goal was to kind of do what the Fed did at one point after 2009, which was create a scenario and create an environment where it kind of forced you and your money into risk assets. The Fed did this very effectively, after the 2009 crisis, reflated through the stock market and let consumers borrow again and so on and so forth. In Europe, though, the misstep has been kind of in terms of guidance. The BIS did a really interesting study on this not too long ago. It was 80-something pages. I read the whole thing. It was fascinating in terms of forward guidance to where the ECB basically said there's no scenario that will be good enough that would even cause us to think about raising interest rates in the next year. This is what they said a year ago. They should have been raising them by now. But that forward guidance is such that it caused fear among investors, among households and consumers. And instead of investing in stocks, what they did was they were so fearful that the message here was, what does the central bank know that we don't know that's coming down the pike next that makes them so afraid to even contemplate raising rates to zero? Okay, that this was an issue now where you're willing to pay governments for 30 years to safeguard your cash. I mean, that is insanity. And it draws all that money out of the real economy, and boom, this is what you have in Europe. It's an absolute mess. You tie all this together, given the European Central Bank situation, what are they going to do? It left the dollar. It leaves the central bank here in the U.S., the Fed, as the one that has to move. We said way back in August, this wasn't going to be quick. This was going to be a multi-step process to get the Fed to where they are today. I think the Fed made two mistakes. They didn't cut rates in December. I mean, they hiked rates in December when they shouldn't have, and then they didn't give any kind of hint of forward guidance at the last central bank meeting when they did, in fact, cut rates. And now you're even in a more intense situation where the fixed income market's demanding even more rate cuts down the road. Throw in the Chinese trade factor, and you got a real mess. And the bottom line, out of all of this, I can shave down what's a really long answer into a very short one. What you have here is growing lack of confidence, anxiety, if not even fear and discomfort around all paper. And it's around paper currencies, paper debt. It's all the same. It's all one big IOU, and the central banks are going to keep doing this. And what are they going to do next time around? 23 trillion in sovereign debt here in the U.S. versus 9. Are they going to print 6 to 9 trillion this time around? Well, if they do, and they probably will, because they don't want a debt deflation, it just creates enormously bullish outcomes, on the probability curve for the precious metals. And we saw that developing. We saw the way the currencies were acting. That gold had broken away from the dollar. Gold was rallying with the dollar. That was huge. And when, we swapped into silver because the gold-silver ratio had gotten completely out of whack, a 30-year high, and you knew then that there was a point, and it was really kind of the next tariffs and the next round of this trade dispute where people became really concerned that they're going to go down such a deep hole here that maybe the central banks are not going to have such an easy time to lift them out of it. And then it became a monetary move more than kind of a bigger picture, emerging market, global macro move. Now it's strictly a monetary move, and that's when silver and even platinum just broke out.
Silver is outperforming gold now after lagging gold earlier in the rally. We talked about that 90+ to 1 silver to gold ratio back in late June, and I know that extreme ratio was part of your reason that you like silver at the time, as you just mentioned. Now, historically, silver does outperform gold when prices are trending higher, but it took a little while for silver to play catch up. What are you expecting from silver given where we are today? Does it continue to outperform, and will we see the ratio fall further in your view?
Yeah, absolutely. I mean, from the longer-term view, this is a 3 to 5 year move. You may have seen a year of it already, so you still have a long, term, 24 to 48 month dynamic underway here. Having said that, there is some chance of a pullback here. So, kind of our upside targets, 1505 was the first one in gold, and you kind of went through it in silver, 1865, and that kind of gave us $21. You're kind of almost halfway between those two levels, so that's kind of interesting. You got kind of a reversal pattern here going on, on a short-term basis. But what's interesting is to see this happen today as stock markets break out on the back of what is now potentially a risk to the dollar. So we just did a big special piece on this yesterday in Weldon Live, which is our other publication other than the Gold Guru, in which we were talking about the risk to the dollar here because of the movement in rate differentials. And one of the things that has held the dollar up, two things fundamentally, has been a fear of a dollar debt dynamic, and that a demand for dollars to repay debt in some kind of debt deflationary scenario would be high and would circumvent anything the Fed did. And there's evidence to suggest that because the dollar didn't follow the Fed funds futures market, that's for sure, and that correlation had been very tight since 2014 and completely got demolished. But what happened in that vein was, U.S. rates were coming down, but not as fast as they were in other places, particularly Europe. So what you had happen was the yield differentials, the bond yield, particularly the 30-year, most highly correlated to the dollar, blew out in terms of the U.S. yield premium because Germany's 30-year was dropping towards zero. Well, great that the U.S. 30-year went from 3.25 to 2 and made record lows. In the meantime, the German 30-year's, flirting with negative yields. So what's happened more recently is that there are limits in physics as to how far and how much of these bonds can go negative no matter how much they talk about. It's not the next big move. You and I have talked about a little bit what's probably coming next. It's going to be monetary, it's going to be QE rather on steroids, all right, probably first from the ECB. But that's still another maybe one, if not 2 steps away as well. And in the meantime, there is some concern here that, in the first phase of a dollar kind of, kind of crack, if you will, that might boost stocks to where money rotates out of metals back into stocks. A very short-term correction could develop here. We're traders, so we're more in tune with that. For investors, who cares? because the longer-term picture, the 2 to 4 year picture, is very bullish, and silver will outperform because this is going to be a monetary dynamic that exceeds all the other monetary dynamics. Look at 1987 and the stock market crash on any chart, monthly chart of the Dow now. It looks like nothing even happened. That gives you the magnitude of where we are now. When you're talking about a 30,000, on the Dow Jones Industrial Average, a 1/3 correction, that's a lot of money now, all right? Because it's 10,000 points. So everything's extrapolated, and it kind of gets back to even our hurricane situation. So a lot of this has to do, and we could get really deep here, but we won't, but a lot of this has to do with astrophysics and where our solar system is in the Milky Way right now. What tends to happen in physics, you have certain readings, Schumann resonance and the Gauss readings. What you have right now is things are increasingly stretched. They're polarized. You see it in everything. You see it in politics in this country for sure, but you see it in the weather. It's not necessarily that it's global warming, although it is. It's record cold, record heat, record flooding, record drought, record hurricanes, record volcanic activity, record everything. That's only going to continue. And in that vein, as you apply that to the markets, the math around the money that's been created, the debt that's been created, when you have to keep this thing going, because to let a debt deflation take over, central banks, that's the absolute last thing they want to see. And we said in the book in 2006, and I say it again here, when facing the abyss of a debt deflation, they will do whatever they have to do to reflate. And what's probably coming next is going to be shock and awe. And you're going to want to be long gold because they are devaluing the purchasing power of all paper. And people are finally starting to see that.
Switching gears here a little bit, Greg, we saw former FOMC member William Dudley write an op-ed in which he suggests the Fed try to unelect President Trump by refusing to provide stimulus and letting the president's trade war pull the U.S. economy into recession. That is a remarkable position from a former central banker to take, and it raises the question about whether the Fed might take an active role in the 2020 election. What do you think? Will the Fed go along with the president and with some of the pressure from the markets and reduce rates in the months ahead, or are they going to allow a recession here for reasons which might include politics?
Well, this is such a double-edged machete. Because, of course, the Fed's political, but, of course, the Fed's not political. So as an independent body, and let's not forget, the Fed was created in 1913 to offset crashes in the stock market. So it's kind of funny that everyone says, oh, this isn't the Fed's job. And of course, this is what they do. It's what they've always done. Alan Greenspan in 1987, I was there. I was surprised. They continually give us more and more creative ways to do things. In terms of what William said, it's almost like ding dong, the witch is dead. Because what he's done is, it's almost like, it's kind of like he's an ex-postal employee. He's gone in and shot up the place because the Fed wants to remain, at least to have the appearance of being totally independent and totally apolitical. And this guy just threw that out the window. All right. This is one of those things where, it's kind of like, if you go into the criminal world, right, and the gangs and what do they call them, cartels and stuff. You snitch, you're done, right? So I wouldn't be surprised they have hit squads looking for this guy because it so taints the Fed. And no, they're not going to do that. I don't think they would do that. I don't think Powell seems like he's that ego-driven. This is Donald Trump's ego. It's not Powell's ego. All right. I know some people that work with Trump, not that I'm supporting either side of any of this. All right. But I think people generally agree, even those close to him, that he can be his own worst enemy. Sometimes you just got to shut it, keep it quiet. And my suggestion with the Fed is the less you say, the better off you are. And he's put himself in a bad position. Why would the Fed then want to feed into that? I don't know. The whole thought process around bringing the economy to a recession to unelect Donald Trump, that is a symptom of what's happening in this country, where the hatred for one man, for his personality, his aura, not his policies. Nobody's really able to separate these two things, and they're different because, in many ways, he's not a likable character. All right, just his ego and his persona and his, he's kind of bombastic and a bit of a buffoon sometimes and waving his hands. He doesn't have the greatest vocabulary. His policies are spot on. So I think the difficulty in separating those two things is when you get a situation like this where the hatred for one man is now trumping, yes, pun intended, trumping the love for country. We see it everywhere, and it just blows my mind. And frankly, it's symptomatic of the things I've been talking about, in more of a scientific angle, because this has an impact on the way human beings act too, and you see it. It's increasing random acts of violence, and it's increasing random acts of kindness. And I'll tell you what, we got a ton of random acts of kindness taking place down here in terms of relief for the Bahamas, because there's a great connection between South Florida and the Bahamas. So you see it on both ends of the spectrum. And for Williams to say something like that only damages the Fed's credibility and is only bullish for gold, because it does so.
Yeah, well put. Well, Greg, as we begin to wind things down in the interview here, I wanted to get your thoughts on platinum, because that's had a pretty good move here recently over the last week. What do you have to say about platinum, Greg? Is it finally emerging from its years-long hibernation?
Well, absolutely. I think when you started to see platinum at exceeding $500 an ounce discount to gold, again, kind of getting back to some of the physics. I mean, you know as well as I knew, stuff's created in a supernova. Platinum is more rare than is gold, and from that perspective, it should command a premium. I understand that's it's not that black and white, but to me, that makes it interesting when you see it at a $600, $700 discount to gold. And when you see and know that the next wave is more of a monetary thing in a bigger picture than really kind of a setup for that, which is when the dollar, was declining against gold. All right, and when gold was making new highs on so many different currencies, record highs. Australian dollar, Swedish krona. It's that simple. You throw those two currencies out there. And in that vein, platinum absolutely was the laggard, because, if this is something that is trade war going to become bigger, that would hurt platinum at the expense of gold simply as an industrial metal. But how much is that priced in? At minus $700. To me, these were steals in platinum and silver at the levels at which they had reached against gold were extreme, and that has really paid off for us. We actually, kept a core holding of gold, but we swapped our big position in gold that we bought at like 1196, and I forget where we sold it. It was above 1400, 1411 maybe, and pushed everything into platinum and silver, which had barely still moved, and that turned out to be, a really good move.
Well, Greg, as we close here, any other final comments? I would like to hear kind of where you're thinking we go from here in the precious metals, and then also maybe tie in the new gold guru say.
Yeah, well, where we go from here, I think, is you have probably some short-term volatility, maybe some downside, but it's an opportunity if you're not invested to get invested. It's an opportunity if don't have like what you might consider the full position you want to have to put it on. In something like we're looking at, for example, the GDX has been one of our picks. I mean, we have a lot of picks. Gold Guru, it's gold-guru, GURU.com. I mean, we have all of this, and today's piece really kind of gives you about what I'm giving you now, and even in a broader sense. But when you look at the GDX, I mean, topped out, at almost $31. It's had a pretty decent, what will be potentially a key outside-downside reversal week here in a lot of these things. Not only that, you have upside reversals in the base metals. I might mention too, copper, tin, zinc, particularly the metals that are in short supply in LME warehouses. But, all of this kind of plays into a lower dollar, which is bullish longer term. So you're looking to buy dips anywhere between the 23.70 and 25.75 level. You got about $2 zone in the GDX. Real quick, I'll give you what we're looking for in gold. I mean, if you get gold below 1370, it's a gift. Your first major Fibonacci is 1407, and you have a low just under there, just under 1400. It's kind of where we ended up getting out and getting it to silver and platinum. So I would think frankly, if you see a 13 anything print, you're potentially backing up the truck here to buy gold. And in terms of silver, I mean, it might have a little more of a downside, but I'm telling you, I mean, there's solid support. It's 17 and a quarter to 17.50. So in anything really below 18, and when you get down to 17.50, may not last real long down there. I think you might, have a correction, get some chop, wait and see what the Fed does. And when you come out of this in the next phase, when the ECB has to do something, because the other part we're working on, we also do Weldon Live as well. So it's the gold-guru.com, and it's, weldononline.com for Weldon Live, which is our institutional product. But today we're working on a piece on, places like Poland and Hungary that have been very strong because Germany's export juggernaut had been so strong. Well, Germany's export juggernaut is not only slowed, it's tipping into a recession. Terrible data today, terrible data last week. We highlighted all Italy, France, Belgium, all these countries. But when you look at Poland, Hungary, and the Czech Republic, they had really been the second derivatives of global economic strength out of Germany, shipping unfinished goods to be finished in Germany to be shipped out. These economies, the inflation numbers there, the production there really starting to fall. Europe has a problem. And ultimately, when they pull the trigger on what's coming next, I think it'll be very bullish for gold. Short-lived, shallowish correction, but don't wait too long and don't hesitate if it happens, because I think you're going to come out of the chutes again to the upside very quickly in the not-too-distant future.
There's a lot of information flying around out there in the financial world, and one thing that I've noticed about you, Greg, is you understand which ones to sort of really look at and pay attention to that drive these markets, and obviously that's what's helped you make some fantastic calls over the last several months and years, and always love having you on and getting a chance to talk to you about that stuff. Hope you have a wonderful weekend. Glad you're going to stay safe from the hurricane there. We're all our best to those that may be affected by that in the coming days, and thanks, Greg. Can't wait for our next conversation. Bye for now.
Always my pleasure, Mike. Thank you.
Well, that will do it for this week. Thanks again to Greg Weldon of Weldon Financial. For more information, simply go to weldononline.com, where you can sign up for a free trial. Be sure to check out the Gold Trading Bootcamp, and now the new site, gold-guru.com. Be sure to check that out as well. And check back here next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Gleason with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.